for working Americans, healthcare is about 0.18% of their total spend. But for working Americans that are 65 and over, it's 0.39%. And then for anyone over 75, it's 0.44%. So like pretty much double the
Mhm.
amount that the average American spends on healthcare. Anyone 65 and above is spending twice as much.
This is like the invisible infrastructure that you're not concerned about because you only get concerned if something goes wrong,
Yeah,
unfortunately. So you don't want to
yeah,
hear about a custodian. Advisors don't want to be talking about custodians unless something goes wrong.
exactly. That's a good way of putting it. It is the invisible infrastructure that you don't. It's turning. It's big too. It's
Yeah.
like highly regulated,
Has to be.
large, complex, and you have like a lot of people don't even know it exists. Welcome everybody to Inside the Flows, episode 11. I'm your host Yasu Says, and I'm a special guest and Inflows contributor, Nashit Patel. Welcome, Nashit.
Thanks, Yasu. How are you? Happy Friday.
Happy Friday, especially from the San Francisco. How you doing over there on the East Coast?
Good, man. We're baking. It's been hot. It's been a hot week in the 80s, so I think a lot of air conditioners going on for the first time. But it's always nice to get that warm weather and not worried about snow and then blizzards coming through. We had a rough winter on the East Coast, so this is welcome.
Yeah, that's it's funny how you talk about the East Coast weather out there in the sheet because I was looking at the statistics, or sorry, the analytics of our podcast Inside the Flows, and we're on a bunch of different platforms. It's not just Spotify and like YouTube, and the analytics tell you the geographic areas of the listeners, and it's kind of crazy how worldwide this podcast is.
Oh,
So
nice.
yeah, it's not just like the US, it's like the US, there's France, there's shout out to the audience members in Slovenia who listen
Nice.
into the
Yeah,
show.
very good.
Ghana, I think it was what was it? There was one Middle Eastern country. Oh, what was it? It was Qatar. There's
All right.
Qatar. We've got audience members around the world
To
in the
learn to
sheet.
say
So
hello and happy Friday in some of these other languages, maybe.
yeah, I exactly. So good. Thank you for listening, subscribing. I don't know the analytics from geographic area for the YouTube. I got to check that out. But yeah, we're on a lot of different platforms now, Nashid. So there's Amazon Music. There's something called like Weezer that we're on, which I don't know. I just I put the show on
Weezer,
every
like the
platform.
band.
Yeah, I think it's called Weezer. Yeah.
Oh, okay.
Yeah, and I just distribute it as much as possible. So
No, it's good. You never know where these. A lot of people are consuming these types of media formats on a lot of different platforms, not just iTunes like the old days. So that's great.
yeah, and we also have started to get comments. So on our particularly our Spotify distribution channel, comments starting to come in regularly. So that's always nice. It's a good reminder that I should tell folks, like, subscribe, and comment on the show. And one thing I'm going to be testing out is like telling folks to not just comment, but give us your thoughts on what we said. And if you have any ideas of topics that you'd like us to cover, please say so in the comments. We definitely read them. And
Yeah, it's great. Submit questions, topics, right?
yep. And also, if you are a audience member that is in the industry and you have a story that you'd like us to look into and then report back on, we're happy to take on those little mini projects, put on our PI hats, and figure out do our little Inspector Gadget and report back to the audience members.
Yeah,
So happy to do that as well.
that'd be fun.
Can you imagine that? Like you're calling up folks, and the person on the phone is like, "Yeah, no comment." It's like or the Wall Street Journal all over again. But no, we've got a great audience. We got a great show today too. We have our weekly recap, and then we have a special topic, which I think folks are going to find quite interesting. It's in regards to inflation, and for folks who are over 65, how inflation impacts them, which not many people talk about, but a lot of people feel, and especially in their wallets. So this is going to be a great episode. Ready to dive in?
Yeah, let's do it.
All right. So weekly recap. It was kind of a roller coaster week this week with markets going up, markets going down. You know, we typically talk at the end of the week. Topic is usually, or the Friday portion of the weekly recap is always on like Iran and oil prices. So nothing like that's going to change. But early in the week, between Monday and Tuesday, there was a big movement in the advisor world. LPL decided to work with Mariner Advisor Group, or Mariner, the parent company, to purchase Mariner Advisor Network, which is a pretty big move in the advisor network space because there are a lot of advisors that are independent that have custody with LPL, but also have an OSJ, which is kind of like a big compliance team on top of them that's independent of LPL. And so LPL and Mariner decided, hey, let's work together, and we'll scoop up Mariner Advisor Network, and Mariner, you can focus on the independent, or excuse me, the 1099s, or the folks who actually work for Mariner. And that was interesting. That caught my attention. Sheet, were you looking at that as well earlier this week?
Yeah, it's an interesting story. LPL is the giant out there. But I feel like this is not a big surprise. It seems to be trending in this direction where you've got folks that go independent in either flavor. They might join an aggregator like Mariner, then Mariner's got their own flavors, and then it's almost like a big fish keeps eating the other fish, right? So it's like LPL is like, you can consider them the largest aggregator out there if you wanted to, but they're just looking for scale. I think all these businesses are looking for um, scale, cost opportunity. We've talked a lot on this podcast about platform technology, tech stack, all that integration in a world where advisor headcount is declining and client demand is not only becoming more sophisticated, but the numbers are going up. And so we've talked about, hey, tech stack helps make up for that delta, but I do think even operationally from a home office perspective, consolidation helps too. So sounds like a good fit. We'll see what happens, but LPL has been doing this for a long time and they're good at it. So not a big surprise. Um, well, I'm now interested to see what comes next for not just Mariner, but then maybe in some other pockets of that independent aggregator space as well.
It just dawned on me, Nashit, that you just made a great point about customing with LPL. For the asset managers and the, let's just say, service providers out there who are not knee deep in the RIA space, like they probably don't understand how important custodying is to the advisor. Do you want to just briefly explain like why custodying with somebody's really important for their business?
Yeah, it's a great question, right? So in my personal experience, I've been with places that self clear. Been at places where we've partnered with a custodian like an NFS or a Pershing or someone like that. From an advisor perspective, your most important job is to know the client, build that relationship, meet the client's needs with actual investment solutions, wealth management solutions, et cetera. Even your middle office, back office is still controlled by either you if you're independent or your parent company if you're at a brokerage house or whatever. But I think the custodian is something folks don't always think about. I know for me, I don't have an operations background. It's not something I really appreciated until I was somewhere where we were partnering with an outside custodian because that a lot of that is about not only where physically the money and securities sit, but I think from an advisor client experience the money movement is super important. And so if you are cashing out, you're trading, you want cash disbursements, you want cash contributions, like all anything think anything related to cash or like the physical security is going through the custodian. And that involves not just operations but client service. It involves security, fraud. Like you want to be in a tight, secure network, so that if your client is asking for money, you can do that safely and efficiently and quickly. So contributions, withdrawals, a lot of those things that we consider back office, and we just think like it's going to happen on its own. The custodian's important there. So that's for the operational flow, but then also the economics of it make a lot of sense too. So you want to be with someone who's providing those services, a custodian that's providing those services for you at a reasonable price. I think the benefit of being somewhere like an LPL where you can be independent and have that custody there as well. Like for independence, that's super important and part of the whole quality control service offering that they are providing for their clients. So if you're going independent, uh, you're used to, maybe a wirehouse being your custodian in house before. You really have to be careful if you go independent who you're selecting as your custodian.
And because that you said it perfectly, and for the retail audience members out there that are listening in, I should say, your advisor that you're working with, they're if you hand them a check, they're not opening up a safe in the back of their office and just holding your money there. No, they're sending it to someone else who will take custody, kind of like you take custody of a child. They're taking custody of your wealth, and you want that to be super duper secure, and you don't want to have to question the custodian. So a lot of the bigger players out there are highly trusted because of their size, not just because of their size, but because of the resources they're putting into making sure that your wealth is safe with them, and transactions are happening when you want them to happen, how you want them to happen, and that you'll be able to pull your money out when you want to, like sell some stock to pay for your kids' college tuition for that year, right? So they're really, really important parts of the ecosystem, and advisors have to have a custodian if they want to successfully run an independent shop. For the wirehouses, like Nishit said, yeah, they already have their own custodians. They don't have to worry too much about that, but the independents do. So it's really important for them to find a good partner like LPL, or I think Nishit said Pershing earlier. There's State Street out there and Brown Brothers. Like it's really important to find a really good partner because you don't want to have custodian headaches like that. That's the last thing you want to have to deal
And as a
with.
client, these are the things. This is like the invisible infrastructure that you're not concerned about because you only get concerned if something goes wrong,
Yeah,
unfortunately. So you don't want to hear about a custodian. Advisors don't want to be talking about custodians unless something goes wrong.
exactly. That's a good way of putting it. It is the invisible infrastructure that you don't. It's turning. And it's big too. It's like highly regulated,
Has to be.
large, complex, and you have like a lot of people don't even know it exists. Wednesday, the Wall Street Journal reported on big bank earnings, and the big takeaway from that is Main Street kind of looks fine, but Wall Street is just printing money. The trade volume year over year is up 17%, which totals $45 billion. And the way you want to think about that is there's a lot of market volatility that's happening. And whenever you have market volatility, trade desks tend to come out on top because that volatility is really transactions. So there's a lot of transactions happening in the volatility, and investment banks and other mid-sized banks, they if they have a trade desk, they are totally taking advantage of that. This is like these are the great times for them where the markets isn't just going in one direction, where they can't really get those transactions through. But uh, that was the big takeaway. I think. Like, what did you think about the bank earnings?
Yeah, I mean, they all for the most part crushed it, all relative to each other. And you make a great point. Volatility, not just the volumes, but in other pockets of these bank earnings, the volatility creates opportunity. If everything's moving in one direction, there's no opportunity to kind of arbitrage or go the other way or hedge your bet and make money in a different turn. So when things are up and down as much as they've been, um, you can recreate your favorite trades over and over again if they're making you money in either direction, which in this case they are, right? So volatility leads to more like interest in paying attention in the market. It leads to buying opportunities, selling opportunities, short-term trading, but everything. So I think in that regard, the banks did really well.
It's interesting. Last week we talked about private credit, and my concern was that investors on the retail side were being put in these kind of private credit funds and not quite fully grasping the risk to them. But in contrast to that, Jamie Dimon said this week that he's actually not too worried about private credit lending basically affecting the markets. And he said it's at least their bank has relatively low exposure to private credit. What he said is he's worried about is defaults. When defaults happen, so what a default is for audience members that don't know is it's basically when you just don't pay your credit card off. You're defaulting on your loan. So he's more concerned about defaults along with investors pulling back. So that you know that's Jamie Dimon. I'd take his word over mine when it comes to these types of issues. So
I
I
do
thought
too.
that
Yeah,
was pretty interesting. Okay.
just for the record.
I don't know. Yeah, these bank executives, they have eyes everywhere. Really, really smart people reporting to them. So I'll take their word over mine.
Yeah, I think what he said made total sense. Again, largest bank in the market out there, has the pulse on Main Street. We're a consumer economy. I know a lot of people like to think that the top 10%, 1% drive everything. But if you look at it, most of our economy is focused on consumer, the average consumer, small business. And if you look at private credit, first of all, not everyone is qualified to get private credit. So for a lot of folks, if they start defaulting on credit cards, car loans, mortgages, that is way more impactful on the broader economy than a smaller population of people that are in private credit. If they lose some money or can't touch the money, they still have liquidity elsewhere. So I think Jamie Dimon is totally right. Like we should be more concerned with the masses and what they're doing with their credit cards and their loans at home. And um, that's again not to bring up 2008, but like that's what happened back then, right? It wasn't always like the top of the market or Wall Street bonuses and things like that. It was middle America that couldn't afford their mortgage, couldn't afford the lease payment on their second or third car. So that's the fragile, that's the strength of the economy, but it's also fragile. So we have to make sure that's okay.
Yeah, well said. Heading into Thursday, Barron's reported that Allbirds stock was up basically 600%. And the reason why was that it had shifted towards becoming an AI company, an AI infrastructure company to be specific. How hilarious is that?
That's
And
crazy.
for folks that don't know what Allbirds is, or they used to make shoes like these kind of I guess recycled material shoes that
Recycled
would
material that you could like throw in the washing machine. Like they're very hip and popular. I never owned any, but they're very hip and popular years ago when they first came out. Because I feel like they did innovate in the shoe space, but maybe a little bit of a fad. Stock came crashing down. And yeah, this reminds me of, we were in college then, but the .com bubble when everybody added .com to the back of their name. Pets.com, the most infamous one. There are other ones too that, just because you add .com or because you want to overnight become an AI company does not mean that your stock should go up.
so funny, man. I actually did buy some Allbirds, and yeah, they were the cool hip thing to do in San Francisco,
But of
right?
course,
You
San
like,
Francisco, I was gonna say.
it's funny because like there's folks who had like the Patagonia vests, and then they had the Dockers pants, and then the Allbirds shoes, and you were like, all right, this is like a San Francisco finance bro hipster right here. The one thing I will complain about Allbirds was that uh, at some point your toes would imprint on the shoe, and then it kind of looked like one of those like finger shoes.
Oh, right.
Uh, or you know what I'm talking about, like the toe shoes that
Yeah,
like
where it like comes out.
yeah. Then you got. I mean, I guess from a revenue perspective. It was probably genius from Allbirds because like you have to get new shoes. Like you can't just
That's
be
right.
walking around with like your toes sticking out. But yeah, so Allbirds decided to pivot. They got a institutional investor to give them $50 million to buy a bunch of graphics cards and a warehouse, and then just sell compute to anyone who's willing to buy it. and that popped the stock almost 600%. So yeah, it's I keep thinking about this AI infrastructure play where it seems like the folks who are in the infrastructure side of the AI craze are just crushing it. Whereas, the on the software side, and the only ones I can really think of is like Microsoft and Google. AI is I don't think it's played out as well relative to the infrastructure folks. So we'll see where this goes. But yeah, Newbird AI. Friday, again, it's like the same old story. The Iran conflict, oil prices. Actually, Iran said the Strait of Hormuz is open, which has dipped oil prices. So you're not seeing that skyrocketing. I think that Saudi minister said 140 or 130, $140 a barrel if the conflict continues on into April. So Iran said the Strait of Hormuz is open, and then oil prices have dipped down. I'm just gonna look it up real quick, Nashid. Where is oil? Brent is at right now, if you don't mind. So commodities. I like to go to the Wall Street Journal's market data website to check it out. So yeah, crude oil futures are at $83, and Brent is at $88. So yeah, it was a pretty big,
Yeah, definitely a
pretty.
recent low, and it's significant because that statement comes from an Irani minister, right? An official with Iran, and not just us saying it's open. So um, we'll see how long it stays open. There are caveats to it being open for the full story, right? They want to make sure the ceasefire across the region is intact, not just our forces, but all parties involved. So it's good news going into the weekend. Hopefully things are calming down.
Yeah, it is, and it just shows you that the markets really don't think this conflict is gonna last that long. I mean, going from over $100 a barrel to like 88, that's a pretty big drop, and it shows confidence that, hey, we're moving past this, and folks want to just kind of get back to, low normal oil prices because again it affects way more. High oil prices affects way more than just gas at the pump, and it's a good segue into our next topic. Nishi, you ready for this?
Yeah,
All right, so the special topic today is basically inflation hitting retirees. And there was the Bureau of Labor Statistics. They put out the inflation numbers, on an annual basis, and more regularly than annually. But they put out their inflation numbers and what they think inflation's at. And there's a little known but regularly followed subsegment of the CPI numbers that they put out, which is the CPIE. It's CPI, and the E stands for experimental. And what that inflation index does is it tracks the expenses for Americans that are 62 and older. So it basically like creates new weights for certain categories like healthcare and gas and living costs. And what we'd seen, and I think it was like a Barron's article, um, was that CPIE for Americans 62 and older was actually running a 1.2 percentage hotter or greater than just the regular CPI numbers. And I thought that was pretty fascinating. I think one of for our audience members that are in the older category, you're probably looking at a future, especially if you're 60, 65. You're looking at a future where you have a fixed set of income. You put in your 30, 40 years of work, and you've built up your retirement package, and then you've decided, okay, well, this is my living cost, and this is how much I'm going to account for my living costs. So here's the number that I'm going to get from my retirement package to spend every month. Well, inflation is your enemy. Your cost rises with inflation, and you hope that that doesn't eat up the value of the dollars that you have saved over and earned over the years of working. And so this was a little bit concerning, Nashid. I don't want to be an alarmist, but when the cost of living for 62 and up is running hotter than the cost of living for everybody, you probably want to take a step back and rethink like what's going on. So, do you have any thoughts on CPIE and older Americans and just kind of walk us through what you're thinking about this.
Yeah, no, it's a very fascinating story, interesting story. We talk about in our space how important it is to plan for retirement. You get hopefully you have a financial advisor, you get to retirement, your advisor's working with you to make those adjustments to what you need on a monthly basis compared to your rising costs across everything. I really thought it was kind of cool that they decided to create a new or experiment with a new CPI based on people in different age groups and how they're living. I feel like that's how it should be because it made me think of the younger side, right? When I was growing up, for me to buy like a video game, whatever my most expensive thing was, a video game system or a computer or a laptop, I had to save money and do it. Now everyone has phones, everyone pays for Wi-Fi. I feel like on the flip side of it, a younger person's CPI would be very sensitive to technology costs and you know communication costs. Um, on the older end of it, Medicare, heating, um, transportation, like there's a lot of costs that are specific or lean heavily into that generation that may not be as impactful on other generations. So I think one, the idea of a CPIE to look at that, I think is cool and its own kind of economic and societal experiment. But when it comes to what we do, all it does is show how important planning for retirement is and a need for a financial advisor is because for those folks, I again, this we worry about this in our country all the time. People aren't prepared for retirement. If they're sitting on a pension, either they're not aware of or can't afford a financial advisor or aren't aware to go into an office and ask for one. This is when they need help. They need help planning. They need help trying to figure out how much of their pension or their fixed income can go towards certain things, and most importantly, how to make the adjustments going forward. So, if we think we're all as humans living longer, living healthier lives, costs for the basic goods keep going up. And then you're also now looking at a CPI where the people that need our help the most vulnerable on a fixed level of income are the ones that are actually experiencing even higher costs in certain pockets. That's alarming. And so I think that's be interesting to see where how long this CPIE runs with the experiment and what we can do with that data, and then what our financial advisors can do to kind of help and adapt to those types of numbers.
Yeah, the I think the all other thing to kind of think about is where in that CPIE are the retirees going to feel it the most. And according to the Barron's article, which was basically relaying the Bureau of Labor Statistics data, like healthcare. Healthcare, the way you want to think about it is how much of your daily spending, or sorry, your annual spend, like whatever you pay for, gas, groceries, uh, Netflix, whatever. You total it all up, then you break it down into categories. And so for working Americans, healthcare is about 0.18% of their total spend. But for working Americans that are 65 and over, it's 0.39%. And then for anyone over 75, it's 0.44%. So like pretty much double the
Mhm.
amount that the average American spends on healthcare. Anyone 65 and above is spending twice as much. And so as an advisor, how do you kind of prepare your retirees for that? And that's where a lot of folks think that financial advisor is going to just talk to you about stocks and talk to you about investments. No, no, like the big value add is the planning. Like, how do you plan for the unknown, right? How do you plan for the future? And these kind of costs are, you know, I would say like in at least in America, healthcare costs has always gone up to the right. It just has never come down. So you have to think about healthcare costs consistently going up year over year, getting more and more expensive, and healthcare getting better. So the drugs are getting better, the physical technology, so like the devices, they're getting better, the research is getting better. So you're going to live longer. You're going to live longer. Cost is going to go up, but you're going to live longer. So there's value in that. But your starting point is, wherever it is, like, in your 50s or 40s, like whenever you start planning for retiring, that is really, 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 really long time from when you're going to hit your retirement. So how do you plan for those increased costs over time? That's where your advisor comes in, right?
Yep. That's the value they add. That's the value of financial planning. These types of costs are hard to predict. Health costs for sure are hard to predict. And so you really need it, not just advice to set you on a path, but that checking in on a regular basis to make sure whatever decisions you started making in your 40s and 50s are still relevant as you approach retirement, because that's the money you're gonna have to live on.
Yeah. What do you think about this idea of stress testing? So basically, we do in the investment management world, we do scenario analysis. So, we'll have like three scenarios, uh, good, bad, and then expected, right? And we have these little toggles where we can say, well, if oil prices are here, then that's going to impact this, stock or whatever. What do you think about like financial planners or advisors like stress testing, healthcare costs for retirees, like literally having like a spreadsheet, or just have AI do it, right? Like just plug it
Well,
in and like you do the math.
yeah, I mean, AI, I'm sure can do it now, but that's foundational for the best advisors that are using those top financial planning tools, whether it's eMoney or Money Guide or something, your own proprietary tool that your employer is using. But for your financial advisor, like that's part of the scenario testing you're doing with your client, or you should be at least, because the toggles you can easily drop. Hey, here's an unexpected $12,000 medical costs. What did that do to your long term projection of continuing to live in retirement or hitting retirement? um, I certainly think I've seen it done. I've seen advisors do it. I've seen it from our home office perspective as we're working with financial planning tools or vendors, and those are the things we want to see, because we want to make sure our advisors are best prepared with the tools that can visualize and present exactly what you just said, Yasu. If an advisor's in a meeting with a client and he or she is talking about a financial plan and living with a fixed income in retirement, you have to show how some of these unexpected events will impact that client's financial situation.
You make a really good point there regarding tools in the sheet. Can you help audience members, particularly those who are advisors or wealth managers, can you help them understand whether they have the right tools for their clients or not? I'm particularly thinking about the advisors and the wealth managers out there who are already very comfortable. They're like, "Oh yeah, my tools satisfy my clients right now," which those are probably the ones who need to hear this the most, like, because you don't know what you don't know, and I get the opposite argument, which is like the grass isn't always greener on the other side, but like, can you help them understand, if they are like the tool, like what they should be looking for in the best tools that they should be using for their clients?
Yeah, I mean that's a great question and probably its own podcast at some point. But
All right, should we
yeah, in
park
a
it?
no, maybe in a short answer, I'd say that it's a great example of how some of even the basic tools are very important. So, from a financial advisor's perspective, yes, you want to create an investment plan, an investment solution to meet your client's financial needs at that time. And maybe you're planning for retirement if you're doing a really good job. But even that's just projecting. And so you can't just project on an Excel spreadsheet. You really do need tools that speak that language, that can engage your clients, can ask the right questions. And so just using financial planning itself, there's plenty of tools out there and different devices and apps that help with that conversation, help with the intake of data, help with the presentation of projections, and tell the story of, hey, how far can my dollar go? Um, for an advisor, it's super important to be investing time and money in the proper tools, especially if you're going independent. I know your priority is probably to maintain client relationships, watch the markets. Everything is about the performance or the existing asset value. But what else? What other services can you provide? And I would say financial planning is probably the most important, because that's going to extend the financial relationship with your client. If they run out of money, they're not going to be able to pay you. So you need to make sure they're not just paying you your advice fee, but also, hey, have you made a plan so that they can live through retirement and continue to accumulate um, wealth and have a plan that works.
Do you think it's, like, painful to switch providers for
Oh,
advisors
I know
or
it is.
wealth managers? Yeah, okay.
Yeah, I've seen it. If we decide to go from tool A to tool B, it's not just implementation cost. And again, that decision is being made with other things in mind, but not all financial planning tools are created equal. Some have even literally different math in the background. So yeah, so you're my client today. I might be promising you that you can hit we're comfortably hitting your retirement target when you turn 62. If we switch tools, the math might be different, and now all of a sudden it says 63, and you're going to be like, whoa, 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 what happened?
Yeah.
It's the different math, different logic in the background. That's just one very simple example that we hear all the time from our advisors because that's the one facing clients. But yeah, I think the decision for which tool to use is of course important, and then you want to make sure that um, you're with the right tool because then things change, right? 20 years ago, it could have been something else that was great, and now companies are innovating all the time in the fintech space. So that's the benefit of having a home office that has a group of people that are strategizing and have the advisor's best interests in heart. And if you're independent, you should take some time to kind of learn about some of these tools or talk to your peers or make sure you're reading up on it because that's your toolkit. It's like if you were a baker or you're bake you need not just like dough and a rolling pin. You want to make sure you've got everything you need to make the best bread. So that's our job, is to make sure we get those tools in the right hands.
Yeah, so you gotta keep going to those conferences, right, that have those, like, booths with the fintech side,
Sure.
like
I mean, we talk about future proof all the time. Like that's why that conference is great for advisors. How many advisors do we run into that are all excited about the different things they're learning because of the tools they see at the booths? Like that's
tons,
great. That's
tons.
great.
Yeah, yeah, I mean, it's even in the name future proof, right? You wanna future proof your business. Uh, no, that's good, so thanks for that, wrapping it up, Nishit. I mean, yeah, the advisors and just folks who have an advisor should be thinking a little bit more about, you know, what does inflation mean to me as a retiree versus like the average American, and is my advisor prepared to talk to me about that, and you as an advisor, are you prepared to talk to your client? Do you have the right tools that are helping you do scenario analysis, for these increased costs that are coming, and extended lifetimes, like because the medical technology is getting better, people are living longer, cures are coming out like I mean, I can't imagine the kind of cures that are going to come out of using AI, AlphaFold and all these, DeepMind and all these cool like, software technologies that are helping advance the future of medicine. So, hopefully you as an audience member are thinking about these things and are going to take some action in the next year to close some gaps that you have. I want to close this session off, Nashid, by asking you my favorite question. What are you looking forward to next week?
Well, so I'm interested more. We touched on the consumer. Um, so tax day was this week. Um, Oftentimes a painful day for a lot of folks. But if you're looking at some of the numbers and data, refunds are up. Quantity of refunds, even the value of refunds. I know my federal refund was pretty good. My state was not the best, but I owe the state, but I got money back from DC, and so I'm interested to see if some of that bounce shows up in consumer numbers. If it helps, pay down some of those credit cards. If it helps boost, going into we're going to be seeing Memorial Day planning, summer planning soon. So I'm hoping that gives while folks may be seeing some pain at the gas station at the pump, I'm hoping people are enjoying their tax refund and spending it and helping us with our capitalist trickle down economy.
Yeah, hopefully they're going to be using it as or hopefully they plan to go to things like Coachella, their refunds. like I don't know if you know, but like Coachella, it's like one of my favorite festivals to go to, and they had their festival
Yeah,
last Friday.
just recently, right?
Yeah, and the main act that everyone wanted to see was Justin Bieber, and it was like his stats are just out the roof. Like the most demand they've ever seen for tickets, the most merch he's ever sold, like the most, like now it's like number one artist streaming on like Spotify. Like he just broke so many barriers, and you're like, oh, maybe if people got a couple of a couple dollars back from their taxes, they probably will spend it on things like Coachella and tickets and
For sure.
events and in our capitalist society, right?
That's right. That's what you want. Pump it back into the economy.
Yeah. So I want to thank you for the conversation, Nashit. For our audience members that are advisors or wealth managers, anyone in the RIA space, if you want to keep the conversation going or ask us a question, please join us on Inflows. You can sign up at inflows.com. We have tons of members now. Everything's been going pretty good. We've got some new and engaged advisors on the platform, so that's really fun to see them.
That's right.
Popping up and asking questions and just presenting themselves and whatnot. If you are a regular listener, please subscribe to the episode. It actually helps with the algorithm. Comment if you want us to talk about a specific topic, or if you have a story that you want us to cover, feel free to share that with us, and we'll be more than happy to do that. We do have the best worldwide audience, Nashit, so I want to thank them for listening in. Also want to thank you for joining us on this lovely Friday morning. So thanks, Nashit, and we will catch everyone next week.
Sounds good. Thanks for having me.